So shall we?
Yeah. So welcome to those just today. This is the third of our enterprise fintech webinars from Adoptech. Today we're going to look at, as you can see, regulators in the pandemic, and your. If you'd like to move on to the next slide, if you are going to tweet this at Disruption House, please, and we always retweet, provided you're not being rude or you're nice about us, and we follow. If you'd like to go to the next slide, perhaps. So we've got Alastair and Rupert. Perhaps you guys first would like to introduce yourselves and introduce your organisations.
Thanks very much, Eddie. So I'm Rupert Bull. I'm the CEO and co-founder of Disruption House. I have a 25+ year career in technology, both as a interest, I suppose, at big companies like Reuters and Internet, and then as an entrepreneur, had my first business I founded in 2001 and built up and sold that Boston Consulting Group in 2011, and then set up in 2015, having left BCG. What the Disruption House does is we build a model for assessing startup sustainability and counterparty risk, and I think those are key area that the pandemic has brought to the fore, and we have partnered with Adoptech in some of the areas to try and help companies address some of these challenges as they are seeking to engage with large financial institutions and equally help the large financial institutions to engage better with some of the fintechs that are either in supply chain or could be in their supply chain. So that's us. Over to you.
Thanks, Eddie. Thanks, Rupert. And good morning, everyone. Alastair Goodwin, Tech. I'm the CEO there. Background: 15-20 years in technology and investment. Most recently, I was at Goldman's for a long time in the Strats team, working with the quants. I looked at ETF and a number of other things. Before moving into financial technology, I joined a Swedish FinTech and was tasked with acquiring distressed technology companies and using their technology and scale to turn those firms around. And so we did that with two subsequent firms, both RegTechs, initially a post-trade reporting that we acquired from Market, turned around and sold the London Stock Exchange, and subsequently a market surveillance platform that we acquired, turned around and sold on to a newly listed AIM company and acquired by NASDAQ. So I set up Adoptech and co-founded last year, and we're all about providing tools and services to accelerate the adoption of so there to assist the portfolio technology firm. That's us.
Brilliant, thank you. Should we move on to the next slide with first question?
Yeah.
Okay, so change regulations, the impact for your fintechs. That's I think Alastair, you picked that one up.
Yeah. So I guess the question is, what regulators are out there impacting all these fintechs and what's coming? Clear to everyone, there's been a huge increase in focus from the on operational resilience and in particular outsourcing to third parties. I think if you think back to 2008, there was a big focus on the financial firms and capitalization, so making sure that they were financial. And I think at least to date, in the recent economic downturn, that I guess that's proven to be useful to an extent, in that the banks are still successfully, at least to date, managed their way through the current economic downturn. But in the last 2 years, there's been a huge shift in focus from financial resilience to operational resilience, and the FCA themselves sort of put comments out there about the fact that operational resilience of firms is as important as financial resilience. And there's guidance coming out from both a European and a local regulator level. Probably first and foremost, locally, the FCA have released an FCA consultation on operational resilience. That's been to the 1st of October for responses due to the pandemic. Really asks financial service firms to do is to that they have the correct governance in place, ensure that they are monitoring all their outsourcing. They need to have a table of all those agreements, and to be able to evidence to the regulator monitoring those firms, they've got certain things in the contracts with those and that they actively managing the risk associated with outsourcing arrangement. There's a link that I will send out after this, a lot more detail on that, because there are a number of regs, and we could spend at least an hour just talking about. But the FCA consultation's underway. As I say, the responses need to be in October. It will impact initially around 2,000 firms, and as a consequence, their technology providers. But then after that sort of 2 to 3 year implementation, it will start to be extended across a wider range of financial services firms, and therefore a greater impact on a wider range of fintechs. The next, and probably more, I guess, more immediately important regulation there, or guidance I should say, came out from the EBAs, the European Banking Authority, released guidelines on outsourcing, which went into 30th of September last year. Now, what the aim of harmonise a lot of the regulations out there across Europe, including the UK, and it brought together a number of regulations on outsourcing to the cloud, regulations that were already covered under MiFID II, and many other regulations. It harmonised those, and the key points of that regulation, really worth touching on a few of them. So what they asked for in those EBA guidelines, there's a sound outsourcing policy and process with service firm. They have to have an outsourcing register that lists all the FinTechs, other outsourcing arrangements, and each of the financial service firms need to determine whether or not that outsourcing arrangement or FinTech arrangement is considered a critical or important function to themselves. To the FinTechs is that every contractual arrangement that the financial service firm has in place has to be updated to reflect guidelines at the next renewal, and by than the 31st of December 2021. So by the end of next year, every FinTech contract needs to reflect these guidelines. What does that mean? It means, for example, that the regulators, so the national competent authority, the UK FCA, they have to have, under that contractual arrangement with the FinTech, they have to have the rights to be able to go in and directly audit the FinTech themselves. In the past, I mean, we haven't seen this to date, but you can imagine the financial regulators are concerned that, particularly there's been the increased use of FinTech, and particularly since some large FinTech, the consolidation risk, they're concerned that they are not directly regulating the FinTechs themselves, and they're worried about the fact that firms are giving up obligations to these FinTechs, but the FinTechs aren't, I guess, holding themselves to the same kind of governance levels that they expect the service firm to. So, as I say, probably the key FinTechs is the fact that their contracts are going to have to be updated by the end of 2021 to reflect a number of points made in those guidelines. So, one of the other things in there is the fact there has to be not just this extended, as we've talked about, I'm sure many of you are familiar, this is quite often a 12, 24-month procurement exercise. The regulator is very clear that it's aware about having that, but you need to have ongoing of your FinTech. So the FinTechs, as a result, are going to, unfortunately for them, going to start getting a lot more questions from clients, and on a much more regular basis. So we talk to FinTech, as you can imagine. Typically, they may get an annual questionnaire from. In many cases, that doesn't happen at all post-procurement. I would expect that change because the financial service firms need to evidence the fact they are their FinTechs on a regular basis. It also talks about in that regulation that there needs to be clear BCP plans and step-in plans. So what that means is, what if FinTech goes bust? What are you as a financial service firm going to do? We touch on that a bit later, Rupert, on some of the things, but some of the options, but very clear guidelines and a process in place that will evidence to the regulator that your operational resilience, you'll still be able to maintain your operational resilience if your FinTechs bust or pivot or for some reason have a disaster. Okay, I think from FinTechs, the other probably key aspect of this, particularly for those cloud-based providers, is that there's increased focus on cloud service. Regulators have been very clear that they understand the benefits, but they've also been equally clear that it introduces different risks by outsourcing to those solutions. And despite the EBA, I guess a lot of the regulations across Europe, ESMA have just released another concept on outsourcing to cloud-hosted providers and the cloud hosting providers themselves, and they released that last month. From what I can see in the analysis to date, it doesn't actually differ from anything that was in the guidance. So we're kind of scratching our heads as to why they've harmonised everything and then their own and release something else. But you know, we will keep people up to date of whether there are any additional implications that come out of that ESMA consultation. As far as we can see, it's covering and asking firms to do the same things. So make sure that your data security is in place. You understand chain outsourcing. What do I mean by that? A service firm needs to understand all the firms that the FinTech on. So the fourth, fifth, nth parties in a chain. Again, just to ensure that, you know, contingency plans and exit strategies are in place. It's very much like the EBA guidelines, just repeated, which I guess we're questioning why. I think they're probably the key ones. Rupert, are there any things that you think maybe I haven't touched upon?
No, I think you're absolutely right, Albert. I mean, I think what we're just beginning to see in our conversations, they're beginning to wake up to this, and I think that, you know, COVID-19 has probably made people realise or think about their supply chain. You've got the regulatory focus coming in at the same time as COVID hit, and therefore actually the sort of self-preservation that the supply chain is sustainable has become so I think it's not just the regulations, but I think the regulations are beginning to trickle through. Certainly, I think, you know, we're seeing organisations starting to reach out to us, say, okay, I'm just beginning to get a feel for this. What do I need to do? So I think it's but I think you've covered what the key points are.
Right. Does anyone have questions for Alastair or Rupert? No? So should we move on to the next slide? Questions at the end anyway. So here's an interesting one. Opportunities for FinTech. FinTechs want to know. I think that's probably Rupert, isn't it?
Yes. So I think, you know, what we've tried to portray here is really in the visual of what do we think is, you know, the I suppose of response within the financial institutions. So clearly are delivering solutions to their clients. What we've seen is that in the probably last couple of months there's been an immediate on just actually, I suppose, being able to work from home, what you historically did in the office. So I think that's, you know, what we call the sort of short-term crisis response. And I think the sort of you know, through in that are anything that's enabling, you know, control of software and data. I think clearly there's been much more focus on collaboration tools. So we're using Teams. We've seen large organizations accelerate the deployment of Teams, you know, Skype for Business and things like that. But there are, I guess, changes have really talked about, you know, just as we were coming online here, that Teams and the Zooms don't yet currently really allow, I suppose, conversations or things like that. So I think, yeah, there's a lot more in the capabilities of collaboration tools, and be some of the sort of smaller vendors, you know, emerging to do that as well. I think clearly cyber security has driven great importance. There's been a huge amount of phishing. There's been all sorts of reports of fraud being perpetrated. So again, a lot of the tools that are coming through, like really focused on helping remote working be cyber secure. At the same time, I think RegTech is also benefiting compliance from home. Actually, you know, the whole, I suppose, focus until has been on securing the thing that people worked in. Now, of course, people are working, distributed in the cloud, and so how do you make sure that people are using mobile phones in a compliant manner, etc. And then I think what we will start seeing just in that sort of short-term operational crisis response are sort of mixed mode of how do we engage the organisation in a distributed way, because actually just the fact that you give people teams doesn't mean that people are actually automatically appreciating or sort of communicating better internally. So I think that's kind of where we see short-term opportunities. I think in the longer term, everyone's realizing that the crisis is impacting the world. I mean, you only have to go on the newspapers or the website to see all the to real world businesses. So I think the senior leadership of financial institutions are starting to realize that the revenue profile is not going to be. I was talking to a asset servicer yesterday, and the whole business model is really predicated on fees that are related to assets under accounting or assets under management, or various other things like that. And so actually, with the falls in values, it's very clear that those sort of fees are going to be falling. So actually, business models are going to have to change, and greater flexibility is going to have to be introduced to get costs down, which I think is where you're going to start to see the move into digital transformation. So I think there have been a number of factors that have been holding back digital transformation. Some of it's been boards who've been very worried about doing things in the cloud, because we've seen that actually, unless you're doing things in the cloud, you're not operationally resilient. There's much greater acceleration towards type solutions. So I think the really the playing in agility, enablement, lower cost, those are going to be important. And then I think because we are no longer getting all of the connectivity we have in offices, you're going to start to see AI being widely, and therefore actually trying to find in maybe it's just the communications going in through Teams or a range of other but within that, then you're going to have to end up with sort of data control and data ethics. So I think how we sort of see opportunities in specific areas, but I think at the macro level, it's just going to be the only way out is to go to much more digitally native, sort of cloud native, and that's going to bring agility. So I think the medium term outlook is very positive, but it won't be positive. I think you've got some pretty good insights on on what's what happens generally to companies as they come through previous financial crises. And I don't know if you think it's a good time to bring that in now.
Well, yeah, I think look back in history, typically, and there's a level of debate over this, but typically the number of insolvencies pick up as we start to come out of a recession. They sort of tend to sort of batten down the hatches, but then as demand and things, and as you'd expect through any big economic crisis, we see accelerated change. Those firms that can't adapt to that as you come tend to start to go into insolvency. Yeah, typically you'll see insolvencies pick up as you come out of a recession. I guess I say there is some level of debate on that, but yeah, that's typically when you start to see firms really start to struggle. But I think on a sort of macro level, this is a hugely positive thing for fintechs. Of course, there'll be some that struggle where they funding rounds struggle for the next, and we know that there are. I know some of this recently suggests that there's a lot of firms with a limited. They've only got, I think, what's the stats, Rupert, on the sort of number of firms? 6 months.
Yeah, 65. So a recent survey that was conducted out of California Startup Genome Project, which reported at the end of April, found that 65% respondents, including 34% of Series A and later startups, have less cash runway. Yeah, so I think those are and actually the reason they did the survey was to try and influence governments to support the startup. So obviously we've seen things like the Future Fund being launched in the UK to try and help do that. I think it is a reflection that people are aware the way you build enterprise technology does require you to be unprofitable for a period of time, and therefore actually, when these kind of foreseen, although it's not inconceivable, because I think people were always aware that there was a pandemic risk, but it was unforeseen when it struck, that actually it will have a enormous impact on the model of these small businesses as well. And actually, if venture capital are struggling to raise money from their LPs because they're actually conserve cash for other reasons, then there's a knock-on effect on the funding that's going into these startup businesses. And so therefore actually are not yet profitable. The only thing you can do is to try and dramatically cut costs. Again, in the same survey, we saw that 74% of their respondents had full-time employees, and 26% of them had to let go of 60% of full-time staff. Now that's really going to affect SLAs and things that people will assign. That's why I think it feeds back into what you were saying earlier, Al, why regulators actually require more of a real-time dialogue and real-time feel for companies who are in the supply chain.
Yeah, I think at least in the conversations with the tech space, actually, there hasn't been, at least the funding doesn't seem to be as much of a problem in terms of there's still an appetite to invest in good companies. There's money there. There's a message we've been getting. It's just finding the right companies to invest in. So I think it's like in anything, will survive, and I think this is a huge opportunity, as you mentioned. Short term, I think I would really be in the FinTechs to focus communications on their existing client base, expand the opportunities of their existing clients. Those financial services are not agile. They're not going to be able to adopt quickly to a number of the new that have come out of this pandemic. There's got to be an opportunity that FinTechs right now to deliver that the financial service firms just can't do in the kind of space of time they need to. I would really be encouraging the FinTechs to really focus on their existing and try and expand within that. It's going to be potentially a little harder to bring new clients on board as we get used to this new kind of communication over Zoom and everything, to get new sales in, maybe at least first. So yeah, that's, I think, short term, focus on within existing client base. There's going to be opportunities there, with not just because of their ability to deliver new services that the asset managers may struggle to do, but also just from a resource. I think they can do it at a cost perspective. The FinTechs can deliver services at an economical rate than the banks can typically internally. So yeah, I think there's opportunity short and long term for the FinTechs.
Brilliant, thank you. Should we move on to the next question? This is another really relevant. I think, Rupert, would you like to take this one? Yeah,
so I think, picking up this point, we do genuinely believe that there's great opportunities there, but the world has changed, and I think what we've seen is that the tier one institutions, more so than many others, have rabbits in the headlights. I think they're sort of caught in a range of things, some of which is they had already recognised that the economic outlook making some of their business not sustainable. So I mean, HSBC has in the news recently that they had a major review that was announced at the shareholders meeting in March, where they were going to wave of redundancies through in order to make the organisation I suppose right-sized for the future. Then COVID-19, and then they paused it all, and now they've just announced that they are So I mean, that's just an example of actually how consumed an organisation is going to be dealing with those kind of issues that were always there, but I think what COVID-19 accelerated it. So I think making new sales to tier one institutions, that is going to be very hard right now. But they have these needs. They and so I think how can you get to ones where clearly they have a large wallet, but it's going to be difficult. Then I think it's about partnerships. So I think how can you way to the people who have the problem when you can't get to them. I think joint ventures or distribution partners. I think we see more and more organizations to build platform type businesses, where actually there's a network effect that comes. And I think, look for those opportunities you may well fill. And I think it's one of the nature is that FinTechs tend to be laser focused on a particular problem, but that one particular problem is often part of a larger workflow. Very difficult to really drive that kind of massive change within a large. If you're a small organization yourself, if you're 15, 20 people, you're a change program through a large tier one bank. But actually, if you're working with people who are a niche solution and you're offering those cost benefit analyses, it's great opportunities. So I think what we feel is really at your ecosystem, understand where you solve problems, and then I think from the perspective of actually the initial fundraising, investment round, so you put together when you were raising money in the first round, have a sense of who is in the ecosystem. Who are you disrupting? And it may be that some of the people you're disrupting, they themselves have. Maybe you can offer a replatforming opportunity where you actually help them deliver to clients at a much lower price point because you've got modern technology, or it could be you just fill gaps and you can partner through them. So I think it's really going to be much more about and I think we can talk a little bit more later, but actually we are doing these things online. We can't go meet people. So actually, making new connections in the world is really tough. So I think the trusted networks, people who already have built up that trust over time and can is going to be very important as well. So Al, I don't know if you have some other thoughts.
I think the bit that I would probably just reinforce from my perspective, the advice I would be giving is just to make sure you're communicating with all your clients. And I know that or something, but whether it's your CRM or your calendar, block of your time put aside to make sure you communicate with all your clients, whether bi-weekly, whatever's appropriate, but just making sure you continue to maintain those relations so that you remain relevant to those clients, and opportunities do come up, they think of you, and that's the first thing they think of. That's the bit that I would just be reinforcing with the FinTechs that sort of I work with.
Excellent.
Does anyone have any questions for Alastair or Rupert? No? Should we move on to the slide? So I think this is an Alastair question.
We got so supporting your portfolio companies to get enterprise ready. Yeah, a term we use quite broadly, but really what we're talking about here is present your service and yourself, your firm, to the financial service firm. It's what I always refer to in the last FinTech I was running was an adult. So from the moment you arrive and present yourself, that firm, you need to be seen, whether you're an early stage FinTech or not, as being an adult. And what do I mean by that? I mean, the way you present yourself, the policy in place, everything about your firm needs to be seen in a professional. I think if you go back a few years, to a certain extent, people would kind of be happy and understanding that, okay, we're dealing with a very early stage firm. They don't necessarily have certain place. They might not necessarily have, an anti-slavery policy in place or something. But increasingly, particularly as the financial service firms are under increasing regulations to ensure when they outsource, the firms meet the same obligations, you're going to have all these things in place, or you simply you won't make the sale, or you'll end up going through 24 months of by the end of which you will have all these things in place in order to tick the boxes to procurement. So be prepared, but before you get to that point, if you accelerate your sales cycle, then before you get to that point, things. So make sure you've got the 70 to 80 policies in place. Make sure, to a certain extent, you can evidence that they're in place and they're being used. That's really what we're talking about when we talk about being enterprise ready. And a lot of things, typically the ones I've worked with, got great products, quite often great, but they're not as commercially minded. They don't have the commercial mind about how they present themselves from day one. And I think, first class. So that's the point we talk about. Make sure when you arrive, you've got so that they, from a governance perspective, from a regulatory perspective, immediately get confidence that no, these guys know what they're doing, and that's what we're talking about, being enterprise ready.
Yeah, so we've got a hand raised actually from Emmanuel. So before I sort of give my other thoughts, would you like to ask a question? I think you might be on mute, Emmanuel. I'm just going to unmute you.
Mute himself. I'm not sure.
Yeah, I think, yeah. So Emmanuel, you're on mute actually. Yeah, okay, you know. Okay, excellent. Yeah.
Yeah, I like the program. The ideas coming. It's really very important. I would like to ask if one wants to set a business, but the obviously everything is being put in place, and then the only thing the person needs is an endorsing body. This is it in line with being an endorsed? Is it part of somebody? And so, this is part of an endorsing program?
Sure. So I think what there is no ISO standard, if you like, for being a startup. So I think there's no official endorsing. What we've done at the Disruption House and what Al doing at Adoptech is complementary, and I think the things that we have done is we've built a model that's based upon academic research and the experience of entrepreneurs who have successfully created before and sold them on as to what they have done. So there is at the heart of where we started, there are high failure rates in B. Now originally we thought it was 80-90%, in fact we now believe it's 60%. But 60% of B2B software businesses will die in the first 5 years under normal circumstances. Get COVID, and that's really based upon statistics about the last 20 years. So 60% may be an awful lot, but 40% is also an awful lot of success. So what we did is we looked at was there a pattern of what the successful B2B software businesses? Because if there's a pattern, you can build a model, and if you can build a model, you can benchmark people against the model. That's what we did. So we spent a long time looking into academic research, of which was actually statistically evidenced, because some of which were 10 years. And out of that, we created our model, which actually is really helping people, but on both sides, understand: are you self-aware? Do you know what it takes to build a software business? It's very different to build a startup to build a business inside a large organization where you've got human capital, you've got marketing budgets, etc., etc. So the skills that are necessary to start a business and grow a business to successful exit, and that usually management team takes place around the Series B stage, are different to what it takes to take a business from Series B to IPO. So really, what we believe is there is a set is that if people do more of the right stuff and less of the wrong stuff, they're more likely to. I use the analogy of doctors and medicine. We all know that if we don't smoke 66 and drink a bottle of 40-degree proof or vodka or whiskey, we're more likely to live to 90. Okay, every an anecdotal story, or a grandparent or a great uncle or a great aunt or who broke all those rules. There are people who break the rules and live to 95. Most of us know that if we follow the rules and general principles, we're more likely to have a long and successful life. In building a business, it's the same, right? You can't robo-build a business. You can't take our model and go, I'm just going to copy paste. But if you do more of the right thing, and so I think the first bit is actually, by you asking that question, you're showing self-awareness. I don't know what I don't know. So actually the whole point of what we're trying to do, and Al's saying it on the whole policies and things like that, is find out what are the things that, the bridges to have to put up to cross the chasms ahead of you. And if you know that and you're well prepared, then you stand a much better chance of success. And that's also, you stand a much better chance because you show investors that you know what you're doing and you're a safer pair of hands.
That's nice. That's nice. I liked it. Yeah, thank you.
You're welcome, Emmanuel. So, are there anything else you want to add to that?
Please come back. Your last sentence.
So I think to your point, Rupert, no, endorsing body, but we help firms present themselves in such a way that they have been adopted. So nothing else to add beyond that.
Okay.
Brilliant. I think that was our question. Are there any other general comments, or does anyone have any other comments to make or questions to ask?
See another question actually. I think
Okay.
Colin, you put your hand up. Would you like to?
Yeah. I was just really keen to understand or to get your thoughts on Wirecard and the impact that may have on our ecosystem in FinTech, because it's also, as I understand it, stopped a number of new FinTechs who have got services with customers getting hold of cash in their accounts, etc. And so it's become a disruptor to the FinTech space, which is particularly challenging right now.
I agree. Actually, I think it. I mean, it actually what Al was saying earlier about the nth degree and who you rely on. And I think things that came through from what I've been reading in the news stories is that Wirecard released very little information about itself. And it's one of the things that we believe in enterprise ready, and it's coming back to Al's point about behave like an adult, is be transparent. You actually the lack of information should be a warning sign, and I think that's kind of what the FT journalist picked in terms of Wirecard early on before BaFin sat on them. And I think BaFin is going to be this, and I think EY, the auditors, are going to be embarrassed. And actually, funny enough, I heard earlier this morning that the head of audit is one of the three partners who audited EY, and Deutsche Bank actually had to come out and that this was a fact, but they had confidence in their chief. So I think that there are a number of unknowns yet that are coming out of it, but I think it is it's the regulators saying, regardless of the size of your counterparty, test and check. Actually, if you're a regulated firm, and some of these FinTechs you pointed out, and Pocket them, and some of the others, have if they fail because they're relying on the FinTech, actually it's they who fail, not regards to the FinTech itself. So I think this is really where the onus is coming of people to understand the business building capabilities. Card was a technology platform, but it was a business run by people, and it's either by people with integrity or not. And so I think what's really coming down to it is, I think what 19 has done is make people realize that actually FinTechs are technology businesses run by people, and you have to understand the people and the motivations and good at and what they're less good at. And that's really where the regulations are driving at. What Al and I are really trying to help people do is to understand what are the upcoming questions going to come because of the regulatory changes, and to so that when you're going out there, you're able to demonstrate to us that you understand the implications of the regulations, and you are them, and you're also transparent about who you are. If you are a 50-person organization, different capabilities to a 5-person organization. If you're a 5-person organization, it doesn't buying from you, but they want to know that, and they don't want you to pretend that you're 50 people. There is a buyer out there who will work with someone who's a 5-person organization. Every 50-person organization was a 5-person organization once, but actually not every large organization is going to work with a 5-person organization. So it's much more about self and track on to those who want to work with you, because actually as a 5-person organization, you offer great flexibility, you offer great innovation, you offer great advantages, but you come with a risk premium. So recognize that you come with a premium and don't pretend that you don't. And I think that's the bit that's really important. And I think what we've seen is too many people have pretended that they don't come with a risk premium, and they've gone out, this great technology, it's going to change the world, it's a moonshot, it's this and it's that, and people bought into that, and to some extent that's, you know, what did and grew at scale. But the 1.9 billion euros that are missing from their balance sheet, I think, is more than the profits they made in the 20 years they were in business. You know, so actually that is major deception of the long on the long term. Just going to cause more people to think harder about it. So the way to counter that is to be early, I think.
I completely agree, Rupert. And the problem in situations like this, where lack of transparency, is that the trust is broken down, and then it makes life for the rest of fintechs. What we see end up happening is then just increase their 12, 18, 24 month procurement cycle, add in an extra 50 questions which aren't relevant, and just actually make, they're asking questions to 50 people, fintechs, that simply aren't relevant to their business, to tick the boxes because of the I guess public problems that have happened in the past. So I think, to your point, it's in culture where firms understand that there are different types of firms and they types of risk, but people need to be more comfortable being transparent about where they are, what stage they're at, and there are different ways to manage risk. That's not to say you can't manage the risk of a 5-person company you're working with. You can. A different way of mitigating the risk. There are different questions you need to ask. Stand in that, and I think that's going to be a cultural change that will evolve as financial service firms start to see themselves more. I think we talk about this quite often, Rupert. Financial services think of themselves as a sort of supply chain, as my service is being delivered off all these microservices being brought together to deliver my service in the same way you would in manufacturing. But I think increasingly people are starting to understand actually that is what we are. We're all these components and we deliver them, and many of those components will increasingly be by third parties. As firms start to think of themselves in the same way manufacturing firms do, I think that culture will change, transparency will, and hopefully we'll see less of these kind of events which just go to unfortunately break down the trust between firms and increase the barrier, which is what we're trying to break down.
Well, I think on the flip side, it points out that suppliers are risky. So therefore, actually, you know, it's because it means that people can't just, you know, run to big. Actually, big can be risky as well. And I was talking to, again, you know, one of my contacts, and they were talking about the credit risk and the models they run internally. And they have a set of ratings that exist today, and then probable risk in the future. And actually, he was saying that, you know, who would have put anything max 30, you know, firm disappearing overnight? And even though there was a 0.1 probability, people have said it's really actually not there at all. It's not true. It is there, okay, and therefore actually when a big system supplier goes down, it's even more dramatic than when a small one goes down. So I think, yeah, it does have an impact. One can't pretend it doesn't. It's why actually, you know, the counterparty due diligence is being by the regulators, but actually it's also for the small companies. It allows them to point out the risk doesn't just sit with us, and it goes back to Al's point. Actually, the more transparent and the more honest you are about the risks that you present and how they can be managed, the better chance you have of a sale in the first instance, post-sale, a long-term sustainable relationship, which actually is what people really think. We're going to end up with a much better run industry as we move to an ecosystem based upon microservices, because actually if you have a microservice type approach, there's much less systemic risk, right? Because actually you can slot out, and there are a range of alternative suppliers. So actually, you know, that being dependent on a concentrated risk is actually systemically more risky than having a range of small fintechs that can be swapped out if they fail. But in order to do that, you have to monitor the health and know when they're getting into trouble. And actually, you know, when someone gets into trouble, it's not the end. You know, there is remediation. So actually, again, the institution can, have a choice to invest. They have money, they can put it in. They can to an alternative one. But also assurance. So actually, one of the things that Al and his team have been developing are assurance, which are really effectively business continuity plans for fintechs. So actually, you can have sustainability in the ecosystem, but it is about encouraging people to think differently and not to fossilize in the last world thinking, the pre-thinking. And I think that's the risk, that large organizations will fossilize, which is why you've actually got to look for the slightly more nimbler organizations haven't got the depth of balance sheet to fossilize. A large tier 1 organization for 12 months, it won't make a huge difference. It will survive. But organizations, they can't fossilize for 12 months without having a major impact upon them. So they need to move faster. So go and find those guys and help them to move faster. Let's do it for their own, I suppose, organizational operational resiliency. But they want to do it in a safe way. So I think it comes back to being and how you can help them and understand how you can help them in a risk managed way. And I think the opportunities are huge.
Right. Thank you.
Should we call it there? I think.
I think so. I think that's good.
Let's move to the next slide, and we'll just okay. So does anyone have any feedback on the way? Just learning. We're still learning. I think it's our 3rd webinar. Seems to run fine now. I'll be posting a link in the NewFinance mailer to the video once it's been edited. I know, Hamad, you asked if you missed the first 15 minutes, and that's let you catch up on that. I think James couldn't see it, but I'll ping it out if you can still hear me.
Yeah.
Anyone have any comments? I mean, it's pretty straightforward. I'm not sure how we would make this better because we're quite limited by the technology. We only have the feature. No hands up. Okay, so let's just move to the next. John,
that's probably one question, Eddie. That's probably one question. If the people technology, then let us know.
Yeah. Is that Colin? Is that another hand, or is that?
To webinar, haven't we? I mean, they seem to muchness in my mind. This seems to work fine. I think for very large numbers, it could be a problem. In any case, so in that case, just thank you everyone. And this was the 3rd of our 3 events, and no doubt we'll be doing some more enterprise fintech events, and I'll let you all know through that we're doing that. So thank you very much. Thank you, Alastair and Rupert, and thank you for coming along.
Thanks.
Thank you very much.
Okay.